All right, I think we're live. Good evening, everybody. Happy Friday, first and foremost. What a crazy conclusion to a wild week on Wall Street. And it's going to get even crazier next week because we are going to hear from the Federal Reserve. Now, today, as you guys know, if you joined the stream yesterday, today was a big day. Okay, two pieces of economic data came out. Obviously, the big elephant in the room is inflation, right? So the CPI numbers came out, and boy, did they come in hot. So CPI increased to about 8.6% in May. So a year-over-year increase in inflation of about 8.6% in the CPI. Now that is the highest reading since December of 1981. Many economists on Wall Street were expecting a reading of 8.3%. And a lot of people, there was a lot of talk if you watched the Main Street financial news channels like Bloomberg, CNBC. A lot of people actually thought we were going to get a very light reading, coming in below expectations, but quite the opposite happened. So expectations were for 8.3%. We came in at about 8.6%. So here's what's going to happen, in my opinion. I think the Federal Reserve, Fed Chair Jerome Powell, is going to need to go scorched earth raising interest rates. So obviously we know that traders are pricing in about a 50 basis point rate hike next week when we hear from the Fed, I think on Wednesday, but I think we may get a 75 basis point rate hike. Now, I'm not sure when the last time a 75 basis point rate hike took place. I believe it was in the mid-90s, either 1994 or 1995. I think it was 1994 is the last time we had a 75 basis point rate hike. But this is serious. You know, as we go into the midterm election cycle and even after, if Fed Chair Jerome Powell does not get inflation under control, this is not a good look for the Democratic Party. Now, I'm not trying to get political. I'm just trying to say, usually what can impact or influence monetary policy or fiscal policy is politics, right? Politics I wrote about in the Behind the Street newsletter. It's possible that Jerome Powell is going to do the dirty work during midterms so we can get inflation under control. So as we move into the third year and the fourth year of the Biden presidency, hopefully we'll get inflation under control so the Fed can start easing again and actually maybe even moderating interest rates or lowering them. But I mean, man, after that 8.6% CPI reading today, I would not be surprised if we get a big surprise in the Fed next week. 5 basis points in as opposed to the 50 basis points as they said. Lastly, which we will talk about, the University of Michigan Consumer Sentiment Index fell off of a cliff. Many economists were expecting a 58.4 reading. We came in at 50.2. Okay, that is the lowest reading ever of this survey dating back to the mid-1970s. So what is that saying about consumers? American consumers are fed up. They're more scared than they were during the great financial crisis of 2007, 2008. We'll talk about that more. We'll break it down. And on tonight's stream, we will actually do a deep dive into the CPI report, breaking down exactly where the inflation is hitting us the hardest. Although I will, say this in full transparency, the core CPI inflation reading, which is obviously excluding food and energy costs because they're considered volatile, that did moderate a bit. But in my opinion, I think food and energy are the most important things. You got to go fill up your tank and you got to eat. But before we talk about that, everybody, I want to wish everybody a very happy Friday. And let's see who we have in the chat. We might as well have some fun now that inflation is ripping. Sally is here, says, hey, Tom. Hey, Sally, good to see you. Jeremy Kong says, hey, good to see you, Jeremy. Dante Rose is with us. Good to see you, Dante. Soho is here. Welcome, Soho. FredX. Always a pleasure. My friend Chris Beeman says howdy. It's 113 degrees in Arizona today. Wow. Chris, stay cool. Please stay cool. We have the one and only Gregory here. What's up, Gregory? Hopefully you had a good day. Soho, good to see you. Arum Z, welcome. Nick Rocks is the end of the week. Couldn't come soon enough. Happy Friday, I know. Yeah, I mean, major financial markets got absolutely hammered today. And I think the market was actually forecasting this yesterday because the last 30 minutes of trading activity yesterday, market dropped 2%. I'm talking about the S&P 500 and the broader NASDAQ composite after the White House actually came out and telegraphed saying that there could be a potential of the inflation or the CPI report actually coming in hotter than expected, and that's exactly what happened today, coming in at 8.6%. Stocks continued to sell off most of the day, and as we've been writing about, if you guys got the newsletter, I did send it out. I think we are going to get one more leg down in this market. Hey, Jeff is here, welcome. Alfred is here, good to see you, Alfred. Mr. Ming says, hey Tom, what's up? Good to see you, Mr. Ming. Beautiful day out here, beautiful night out here in Miami. I'll show you guys some of the buildings here. We are located right outside of the 200 Southeast Financial Center. I think Goldman Sachs has an office in here, I just learned today. Joan is here, Ruby Falcone, welcome. Hopefully you are fantastic. Happy Friday. I see Sinjib. Good to see you, Sinjib. Shadow Ship says, hey, Walks from Wall Street. Good to see you, Shadow Ship. Don Smith says, happy Friday. Good to see you, Don Michelle K. Says, good evening, everybody and Tom. Thank you, Michelle. Let's see who else we have. I don't want to miss anybody. Jason Francis, welcome. Buy the book. Sherry Rodrigo. Welcome, welcome, everybody. Jeff says, Tom, my portfolio is down a lot today. We're going to crack the lows in the S&P, the NASDAQ, and the Dow. You know, I think, as we've always talked about, Stanley Druckenmiller, Paul Tudor Jones, all the investing greats of our generation and previous generations, the number one rule in the market has been don't fight the Fed, right? Don't fight the Fed. So what does that mean, right? When we say don't fight the Fed, that essentially implies that the Federal Reserve or Fed Chair Jerome Powell monetary policy is the number one driver of the market. Now that's up for debate, I understand, but it's very coincidental, is it not, ever since that the Federal Reserve came out saying that they are going to raise interest rates, and June 1st, which was last week, we started to unwind that Fed balance sheet, essentially made up of mortgage-backed securities and U.S. Treasuries. Stock's been under pressure. Bear market, severe bear market across the board. Even though the S&P 500 technically, on a technical sense, down 20%, but you guys know in the chat and I know that we have been in a bear market. But I think any sort of is that, because when you look under the hood of this market, what have we seen for the past almost 6 or 7 months now? Stocks absolutely cratering, and a lot of the times the indices will cover up or disguise a lot of the carnage in the market because these indices are market capitalization weighted indices. Right, so you can have a vast majority of the specific stocks in the indice below their 50-day and below the 200-day moving average, but the stocks like Apple, Google, Facebook, all of those big mega cap tech stocks will support the index. But we're just starting. Amazon is now down 40% from record highs, so the damage is just starting to show up a lot in the major indices. But if you guys, everybody here, we've been talking about it for a while. You know, we've been in this severe bull market for a long time, and it started when the Federal Reserve started to raise interest rates. So do not fight the Fed. Savi is here. Says, good evening, Tom. Welcome, Savi. Vinny Castellano, good to see you, my friend. Hopefully you and Maria are doing well. Mario says, Kendall, Miami. So we are in downtown Miami, overlooking Brickell. I think Kendall is, I actually don't know where that is. I know it's a really nice neighborhood. I've been there one time. Eyeglass Lady says, those with retirement on the horizon don't have time for their side of a correction. This is Eyeglass Lady, good to see you. Mario's here, welcome. Kim says, greetings everybody, good to see you, Kim. You know, I noticed the water has been more rough than usual. Jacob's here, says, is there anything the Gov can realistically do to reduce the amount of cash? Well, the Federal Reserve is not a government entity, right? It is its own private entity. But yeah, what you can do to essentially reduce the amount of cash floating around in the economy is you can, number one, reduce the Fed balance sheet, right? That is a way for the Federal Reserve to essentially remove liquidity or move cash that's floating around in the economy. And if you want to know a little bit more in detail sort of summary on that, if you type !news, NEWS in the chat, read the latest edition of the Behind the Street newsletter that I wrote for everybody that came out Tuesday. I did a real deep dive into essentially the tools the Federal Reserve has to kill inflation, which would be raising interest rates, number one, and then start quantitative tightening. And quantitative tightening is when they reduce the balance sheet or let securities that are maturing roll off the balance sheet. Let's see who we else have in the chat. Let's see who else we have in the chat. Wendy England, good to see you, my friend, says, I feel like garbage, but it is just a head cold. Well, please get well soon. Make sure you stay hydrated, drink a lot of water. Sinjib says, hey, Tom, happy Friday night. Good to see you, Sinjib. Hopefully you are well. Joan is here, welcome. Lee Sign is here. Says, hey, good night. Enjoying the live as always. Thank you for being here. Thank you for being here. Aline says, hey, from Neil and Kelly from Nottingham, England. Wow, very cool. Well, thank you for watching and welcome to Miami. It's a pleasure to have you here. So I think what we're going to do today is we are going to cross the bridge. But before we do that, I think we're going to go down by the, I'm not so sure it's called the Riverwalk, but it's right near the Epic Hotel. So we're going to do that. I want to take a walk under the bridge, and hopefully we'll be seeing some crazy boats or yachts go in and out under there. But just as a quick recap, everybody, what we're going to be talking about today are the main two pieces of economic news that we got today. So number one is the CPI report, or the Consumer Price Index, which came in hot, hotter than expected. So many economists on Wall Street were expecting a reading of about 8.3. We came in at about 8.6. And that is the highest reading since December, I believe, of 1981. So if we think about that, the highest reading since 1981, keep that date in mind. Keep that year, the 80s, in mind, because we're going to talk about it, and we're going to talk about somebody by the name of Paul Volcker. So Paul Volcker was a former Fed chair, and we're going to talk about in an inflationary environment during the time that he was Fed chair. And I believe, it's been a long day for me, I don't want to get the dates wrong, but I believe he served from, I think, 1979 to 1987 or I think it was that range. You guys could fact check me. You guys are the ones sitting in front of your computer and Google. But I think he served from 1979 to 1987. And the reason why his Fed presidency or Fed chair was so iconic is because he raised interest rates all the way to 20%. So the Fed funds rate went all the way to 20% in order to kill inflation, double-digit inflation that it be. Crazy inflation. We're not that bad yet. Could it get that bad? I don't know. We'll talk about it. We'll discuss it in the chat, but we're going to go in depth, do a deep dive into our friend Paul Volcker, and then talk a little bit about the Volcker rule. Eyeglass Lady says, I too remember Volcker. Yes. Hey, Bernard Friedman is here. Says, I am now a moderator in one of the live streams. Very cool. It's good to have you here, Bernard. We are right outside the Epic Hotel. Hey, Roy. What's up? Roy is here from California. Good to see you, Roy. Kerry says, go Warriors. Good to see you, Kerry. Always a pleasure. Bob says, I remember Volcker. Good to see you, XOXX Bob. Kerry says, hey, from San Francisco, California. Definitely want to visit San Francisco, California sometime soon. Definitely want to visit sometime soon. But this hotel always has really nice cars outside. Alfonso Gonzalez says, good evening, Tom. Good to see you, Alfonso Gonzalez. So just bear with me, guys. We are dealing with a different gimbal, and it's very hard to maneuver. Jacob is here. Says, hey, Tom, can you talk about your opinion on Fed raising rates and reducing the balance sheet? Will that help much? Well, so here's the thing. They're going to need to do something. So we just got a 50 basis point rate hike, right? And the Fed, which we are going to hear from them on Wednesday, they've already forecasted to the market that at every single Federal Reserve meeting, we're going to get a rate hike. Many people on Wall Street were thinking it was going to be 25 basis points, which is the norm, but I think things are getting a little bit out of control, so that has been upped to about 50 basis points. However, after today's reading, the futures market is actually signaling that there could possibly be a 75 basis point rate hike next week. So here's my thoughts on that. And I'm going to try to be I think it's going to be more productive when we have this conversation, leaving our personal politics aside, because it really doesn't matter. We're going to try to look at this as an analyst. So it doesn't matter if you're for Biden or for Trump or for whoever, a Reaganite or whatever. It doesn't matter. So here's what I think. The Federal Reserve needs to raise rates very, very aggressively, or else inflation is going to continue to run wild. But here's the bad news. That's not going to be good for politics. It's not going to be good for the Biden administration. Why? Because asset prices are going to absolutely crater. I'm talking about unbelievable destruction in the equities market like you've never seen in your life. If you start raising interest rates in increments of 75 basis points back to back to back, almost every single meeting, including in September. That's what we should do, okay? Because if we look at the data and we analyze the data, the vast majority of Americans, right, if you're in the middle class or the lower class, let's say you're living on minimum wage or you're just a middle class person, you don't own a lot of assets. The point I'm trying to make is the top 10% of Americans own about 90% of all the equities, right? So I'm talking about all the stocks, all of the assets. So if you really, really raise interest rates aggressively and you increase the quantitative tightening from what they're doing now, I think 60 billion a month, and then after 3 months it's going to go up to 90 billion a month. If you triple that that will kill inflation, but that will also destroy the stock market. Obviously, that wouldn't be a good political move, because as we head into the third year of the Biden presidency and the fourth year, which the fourth year I think is the most important because it's an election year, right? If everything is crashed and the equities markets are down 60%, that's not going to be a good look. But that would actually be a good thing for the middle class and lower class Americans. So why do I say that? I understand the vast majority of people have 401ks and IRAs and all that stuff, but if you look at the grand scheme of things, the ratio of wealth that the middle class holds in proportion to the top 10% is pretty much nothing. So even if you crashed all this stuff, got inflation under control back to the Fed's 2% target, well now, if you, assuming you still keep your job through the recession and everything like that, you know, that $450,000 starter home should now be about maybe a $200,000 starter home. So it'll allow people who have diligently saved their money to acquire assets and have actual ownership of these assets, not at ridiculously crazed prices. Because you got to understand, the reason why a starter home in the United States is over $450,000 on average right now is because interest rates have been artificially suppressed. I think that's a dolphin. Hold on, let's check that out. Interest rates have been artificially suppressed for so long, right? So if I can borrow money literally at less than 3%, well, that means everybody's going to want to do that, right? Everybody's going to want to borrow money at less than 3% because they could leverage out these properties like crazy. Thus, it creates a huge, huge demand for property and bidding wars and all that stuff. But let's say if you have 14% rates on a 30-year fixed, and I know some people in the chat are probably old enough to live through that, right? When if you went to get a mortgage, it would cost you 14% on a 30-year fixed. You know, the relative valuations of these properties are probably going to come down, right? So that would be good for the health of everybody. But that's when you head up into and run into that political game where, you know, the presidents, and President Trump did the same thing too. He's like, oh, look at the stock market, look at the stock market. Under me, the stock market is going to the moon. I'm the best president. The economy is doing so great. Not true. Not necessarily true. And you guys know that I tend to lean conservative. But if you actually look at the data, Trump spent so much money and printed so much money. So there's a direct correlation between money printing and fiscal stimulus and poor monetary policy and artificially low interest rates and the trajectory of asset prices. So you could spend like crazy to stimulate the economy and have the Federal Reserve expand their balance sheet. And yes, asset prices will trend higher, but here's the reason why it doesn't help out the average guy. Well, if you don't own any of these assets, is it really helping you? Not really. And I think that's why we've seen this creation of the quote-unquote two-tier society that I often talk about. When you have the top 10% of Americans owning 90% of all the assets, and the Federal Reserve continues to print and print money, well, those assets are going to get inflated, which is making the wealthier even wealthier, but the people who are at the lowest 90% of America, it's going to cost you that much more just to try to obtain those assets that are already being inflated. So that's sort of my take on it. It's sort of like you're damned if you do, you're damned if you don't, but if we went back to the policies that Paul Volcker did, that would kill inflation, and that did kill inflation, right? But you're going to have to get extremely aggressive on raising rates, and we're going to have to live through a recession and some hard times. Ever since the lows, or ever since the 2008 financial crisis, we were never allowed to go through a hard time or a recession ever again. And that's why they've coined the term like the Fed put or the Powell put, right? So when anything goes wrong in the economy, traders always bet that the Federal Reserve will step into the market, interfere, start buying mortgage-backed securities, start buying U.S. Treasuries, dropping interest rates, thus stimulating the economy, and the stock market goes up. But now that inflation is getting out of control, you have to raise interest rates. So I think next week, and we'll cover this more on the stream, probably on Monday or Tuesday before the report, I think the appropriate thing, the moral thing, and the ethical thing would be for Fed Chair Jerome Powell to come out on Wednesday and say we're doing a 75 basis point rate hike. So a little bit long-winded, but hopefully that made sense. But that's just my take on it. I'm not saying I'm right. That's just my opinion. I'd love to know what you guys think. Hey, we have Josh D is in the chat. Says, I wake up, go to the gas station, then go to work, then back home every day. Nothing affects me. Says Josh D. Good to see you, my friend. Zombie Coco says it's beautiful outside. Good to see you, Zombie Coco. Indeed, it is very beautiful out here. So I'm not quite sure this is called the Miami River Walk. I believe on the other side it's called the Miami River Walk, but this is one of my favorite places here. XOX6 Bob says Volcker's rate hikes were very harsh, but it was needed at the time. Yeah, I mean, Bob, I think you're right. But isn't it interesting, and we'll talk about this a little bit later in the stream, but isn't it interesting that the inflation really started to ramp up during the latter 70s and 80s? Because if we think back, if we go a little bit further back throughout history, what happened in 1971 to 1973? Does anybody know the big economic event, probably one of the most iconic events of all time in American history, that happened in 1971? Does anybody know? Wow, the view is really beautiful from here. Maybe we'll walk all the way around tonight. I don't think we've ever been here. Yeah, what's next is the gold standard. You're exactly right. So in 1971, Nixon took us off the gold standard. And during that time in the FX markets, the currency markets, the US dollar absolutely plummeted. So what does that mean for import-export? Well, prices would have to go up, right? So that causes inflation just with that. And that goes back to the whole argument when we've covered this on streams multiple times about the evils of fiat currency in and of itself. Jewel Morris is raised by 75 basis points. Get it going. Yeah, well, I mean, the futures market is actually pricing that in. But we'll see. I mean, we'll see. Well, did you guys see Jim Cramer came out today and said Fed Chairman Jerome Powell has to actually raise it by an entire point? 1% rate hike. I doubt that's going to happen, but we'll see. Flat Smack is here. Says, hey, Tom, gold bugs are rich for a reason. This is Flat Smack. Good to see you, my friend. Always a pleasure. Sally's here. Says, beautiful view, Tom. Welcome. Matthew says the dollar was taken off the gold standard by Richard Nixon. Bingo. Don Smith says August 15th, 1971. Good to see you, Don Smith. Super Beast 001. Good to see you. Sean Connolly, welcome. Check out this boat, everybody coming by. I'm not sure if you guys can see that, but look at all these people on it. Man, check that out. Hey, Sally is here. Welcome, Sally. Always good to see you. Yeah, Humane's like lovely boat. I would prefer a dolphin. Well, hopefully we'll get him soon. And check out the Metro Mover. We got to take the Metro Mover tonight. Maybe we'll do that. Yeah, sorry about that, everybody. I'm getting distracted. I'm looking at all these boats. Hey, Carrie Henry is here. Good to see you. So yeah, going back to what we were saying, right, about getting off the gold standard in 1971, I think the reason why it was so significant is because if you look back throughout history, and there's a lot of really good documentaries on this on YouTube for free, by the way, that I would highly recommend you checking out. But literally the moment that we did that, the dollar's value cratered on the FX markets, essentially making import prices higher, right? Thus creating inflation. So if you run a multinational company or you have trade, right? You're not like a hermit like North Korea and you don't trade with anybody. It's not good when your currency craters and plummets. We got another boat coming here. Hey, Walking Minnesota. Hey, what's up, man? This is a very difficult situation. Average American wants to see focus on Main Street, but without support for Wall Street, we end up with a financial crisis. Interesting point there. Interesting point. I see where you're coming from. Hey, Guillermo is here. Welcome, Guillermo. Kevin Ramsey. Welcome, Kevin. No way, the Swan's here? I gotta see that. Maybe someone was just kidding. You guys almost made my Friday night. I thought this Swan was actually here. So everybody, I'm not sure if you have Twitter, but if you go on my Twitter, at Walks Wall Street, if you follow me on there, I retweeted an economist from the Washington Post, and I forget her name. I was working all day, I forget. But check out my Twitter feed, look at the retweets, and she did a phenomenal job of breaking down the CPI report and giving very, very detailed information on inflation. So check this out. This is really interesting here. So groceries, and this is a year-over-year change, by the way, just for some context. So groceries year-over-year change, up 11.9%. That is the biggest increase in groceries year-over-year since 1979. Insane. Second thing, chicken. Getting really specific here, that is up 17.4% year over year, the largest price increase in history. Moving on to number 3, restaurants. In general, restaurants, if you go out to eat, year over year increase for the month of May, 9%, the largest ever in history. Fuel oil, up 107%, the largest year-over-year increase ever in history. We're smashing a lot of records here. Electricity, up 12%, the largest increase since 2006. Rent, and if you guys want to know a little bit more about the rental crisis in the United States, go back 2 videos ago in the channel. We covered it on the whole show. We talked about it for like 2 hours. Rent is up 5.2% year over year, the largest increase since 1987. 1987 was the year Paul Tudor Jones predicted the stock market crash. We'll read the rest of them later, but we have the drawbridge going up here, so I want to walk over there and check it out. But check this thing out, everybody. It's like a little tiki shed. Hey, sunshine after rains like Tom, it's $40 for 2 small cuts of ribeye at the grocery store. Insanity. But since it's Friday, we'll pause the conversation for a second. We'll check out the drawbridge, because there's probably going to be a monster boat coming over here. But yeah, I really wanted to give her a shout out. I always like recognizing people when they have exceptional work. So if you follow me at Walks Wall Street, you could see where I retweeted her work there on really breaking down the intricacies of the inflation report. Really, really well done. Really, really well done. And you could actually see it line by line, just how crazy a lot of these prices are getting. What really resonated with me, because a lot of the times, we could read a lot of these statistics, but oftentimes it doesn't apply to your daily life. So here's one for me. So check this out, airfare. If we want to talk about airfare for a second, up 37.8% year over year, the largest increase since 1980. And I think I've told you guys about this before. I used to get flights for about $50 back and forth between New York City and Miami and vice versa. Now you can't find anything for less than $200. That's well over 100% increase, well over. So really, really crazy. But then I was like, okay, to be fair, is this just seasonal? And then I looked back at some of my receipts, because I always do for expenses for like tax reasons. And no, I always have paid like anywhere from $50 to $70. And just as a little bit of a tip for anybody who wants to visit Miami during this season, specifically the summer months, it is always cheaper to fly from the Northeast to Miami from May to about August. And that's because it gets extremely hot down here and humid during the summer. And usually a lot of the people that live in the Northeast, they call them snowbirds, and they tend to actually come down here in the winter. So usually you'll pay a little bit more of a premium to travel from New York City or Boston or wherever you're coming from to Miami, starting right around the holidays, and then going all the way through February and a little bit into March. That's when you could see those ticket prices be a little bit steep. During those times, I usually have paid around $150. If inflation continues the way it is, I mean, I may have to start paying like $300 for that, which is definitely not a good look, my friends. Here we got a little boat here. Let's see who we have in the chat. Hey, Joel is here. Says, what's up, Tom? Straight from Brazil. Ah, very cool. Good to see you, Joel. Hopefully everything's going well in Brazil. And thank you for joining, and happy Friday to you, my friend. Mario is here. Good to see you. Mr. Mings is done cooking my spaghetti for dinner. Sophie M says, broccoli here in Australia. Says Sophie M. Good to see you. Dallas is here. Says, hey, Tom. Good evening. How is your day going today? So my day's going good. It wasn't as busy as I thought it was going to be. I actually had a lot of clients cancel meetings, which I guess was good, but then it's also bad because I got to get some stuff done. But it is Friday, so I don't blame them. Dennis Henry says, not only are the airfares outrageous, but you have the additional risk of all the extra cancellations happening right now. You know, Dennis, I never thought about it like that, but you're absolutely spot on. You're absolutely spot on. So that actually happened to me, Dennis, not too long ago when I went to Austin, Texas. My flight was supposed to take off at 8:15, 8:30. I took off at 1:30 in the morning. I got to Austin, Texas at like 4:30. It was crazy. So you're right. I mean, absolutely, not only are you paying more, but definitely a lot more cancellations now, which is a little bit out of character. 61 says, hello, Tom. This is a great country, and I hope things will get better. Yeah, I'm always optimistic. So that's sort of what I wanted to get into the latter part of the program of the stream. I know that the inflation report came in hot, and I know consumer sentiment is at an all-time low. So the University of Michigan Consumer Sentiment Index came out at 50. Economists on Wall Street were expecting a 58 reading. So talk about absolutely getting hammered, falling off a cliff. But if the Federal Reserve does the right thing here, okay, and we come together as a country, which is probably almost impossible, but let's just play this through for a minute. If we come together as a country and say, look, I know things are crazy right now. We have to agree with each other that all of these problems in relation to inflation and the wealth gap in this country is because of the Federal Reserve. If we can agree on that, then we could turn to Fed Chair Jerome Powell and say, you got to take these interest rates to the roof. And that's going to cause some pain. It's not like it's going to not cause any pain. There's going to be layoffs. There's going to be mass unemployment. The S&P 500 is going to crater even more. But that's a temporary thing. It may take us 3 to 5 years to emerge from that recession, but when interest rates are normalized, the people who are diligent and save money, they're not forced to go out into the marketplace and search for yield, right? So there's a terminology on Wall Street that when interest rates are artificial, in turn encourages speculative activity. Artificially low interest rates encourage speculative activity. Well, it forces investors to go out into the marketplace in search for a yield. So why does it do that? Well, if you put your money in an interest-bearing bank account, you're going to earn less than a fraction of a percent, quite literally, when interest rates are artificially suppressed. So knowing that, why would you ever keep your money in an interest-bearing account if you know that if you keep it there, you're going to, judging by the fact that inflation is running at 8.6%, right? So what that forces people to do is go out and gamble in the stock, get involved in sports gambling, the GameStop, the meme stocks, all of this crazy stuff, because people think and invest in equities and lever up long and use margin just so I can outpace inflation. But when interest rates are normalized, like they were when my grandmother was around, you could actually save money in a bank account and accrue interest and compound and save to then buy assets, right? Which would be, income producing real estate or actual real companies that are publicly traded that are having positive earnings, positive free cash flow, right? But now a lot of these stocks that people and investors are buying, these are very high beta speculative growth companies that have no earnings. They have no EBITDA, negative free cash flows, right? So it forces investors to go out and speculate when interest rates are artificially low. So I think that's what needs to be done, but it's not like it's going to come without any pain. If interest rates really normalize here and get up to those levels during the Volcker term, which I doubt it'll ever get that high, but there's going to be some serious pain. But then I think after that, it would probably be one of the strongest economies the world has ever seen if we get back to sound money policies. But that's just my opinion. There's a lot of other opinions out there. I think a lot of the Keynesian economic, I would say, studiers or people who study Keynesian economics would probably disagree with me. And I think that's fine. I think it's good for some civil debate. Richard Walters says the value of retirement accounts would decrease if there is a crash, says Walter. Richard Walter. Yeah, you're right. You're right, Richard. You were right. Tiago Pereira is here. Good to see you. XRP says no skin in the game. Good to see you, XRP. James says good time to be working and contributing to your retirement accounts. You're right. I mean, I think looking on the bright side of things, as James is saying, let's say if you're just coming out of college and you're just learning about the equities market and stocks and investing. Well, the NASDAQ is off about 30%. The S&P 500 is off about 20%. So I think this is a really, really good time to learn how to invest properly. And if you guys saw the Behind the Street newsletter this week, which is a free investing newsletter that I write every single Tuesday for everybody, I actually included my top 5 books of all time. If you want to learn about Wall Street, if you want to learn about investing, check out those top 5 books. So if you scan the QR code on your screen, it'll bring you to the link where I will share with you those top 5 books. But Margin of Safety, Seth Klarman, and many, many others. So I think during times of economic downturn, economic uncertainty, or even just bear markets in general, it's so important to even be more engaged with the markets. Understanding how to actually fundamentally evaluate companies based on real earnings and EBITDA, as opposed to, oh, just what is the company's ARR, annual reoccurring revenue. So if you scan the QR code, punch in your email, and I'll keep you up to date every single Tuesday after the market closes. Once again, that is the Behind the Street newsletter, and we did post our 5 favorite investing books of all time. But now we're going to cross the bridge, and I will bring you guys with me. Yeah, Photos from Around New York says, and investing in yourself with skills and education. Couldn't agree more. Photos from Around New York, happy Friday to you, my friend. Hopefully you have some interesting plans for the weekend over there in New York. I think the weather's going to be really good too in New York City. Billy Bennett says, it wouldn't hurt to put The Richest Man in Babylon on that list. That is a good one as well. I've read that book many times. It is a very good one as well. But in terms of like learning how to evaluate companies and things like that, I think maybe like a Seth Klarman Margin of Safety is probably better if somebody wants to learn like fundamental securities analysis, things like that. But you're right, that is a fantastic book. Hey, Annie R is here. Says, hey Tom, I saw a tweet today. Saying Canadian and Norwegian banks are the least capitalized banks in the world. That would actually surprise me. I'm gonna have to do some due diligence on that. My guess would be something else. But thank you for letting me know. And if you want to share that tweet with me, please do. Please do. You know, we'll walk by the Whole Foods and then around here so you guys can see the Miami Tower. Michelle K, welcome Michelle K. Strider 1239 says, what would you say someone who is near retirement, 5 to 8 years? Oh, I just lost your comment. Should they continue to work and build a bigger nest egg or ride out rebound? Yeah, I mean, I would say to work as long, I mean, if you enjoy what you do, I would say, you know, work as long as you can and stack that cash away, right? I mean, the more the merrier in your retirement. You know, the best times historically to be investing aggressively in your retirement account, if you have about a 5 to 10 year time frame, is during times of economic distress, right? Because you're going to get asset prices that are extremely depressed. So there's an old saying in the market, asset prices tend to surprise to the upside, and they also tend to surprise to the downside, which means during times of economic prosperity, you'll tend to see stocks trade at premium valuations, or you may consider them overvalued. But stocks could stay overvalued for a long, long time, which we've seen during this previous bull cycle. And stock valuations can stay depressed or undervalued for extreme long periods of time as well. And that's why it's more advantageous if you're investing on a long time horizon. Let's say if you're dollar cost averaging into an index fund that tracks the S&P 500 or something, it's advantageous to add more aggressively during times of economic distress, assuming you have about a 5 to 10 year time horizon, and that's disposable income that you don't need to pay the rent or to pay your household bills or your car payment or things like that. So that's what I would say. But that's just coming from a random guy on YouTube. We're just sort of shooting the breeze here on the stream. Hey, Dr. Longus is here. Good to see you. Says, hey Tom, reverse bad oil policies and watch things get better. Yeah, I think that would definitely solve one piece of the puzzle, right? I definitely agree with you on that. But good to see you, Dr. Longus. LaFresh Sinatra is here. Welcome. It says, Teresa, that's a great point, yet people seem to not talk about it. What point was that? Let me read that. Teresa Roberts says, hey Tom, are you taking into consideration certain global forces who may be deliberately trying to crash the financial system using mass media and world governments? Could you clarify a little bit more? So this is the Aston Martin building here. But Teresa, please clarify a teeny bit more as to what you mean by that. Do I think that there is like a conceited effort by world leaders to crash the economy? I don't personally. Davi Muniz is here. It says, hey Tom, I subscribed to the newsletter a few weeks ago, but never really got any emails, even though I confirmed the subscription. Tried subscribing again now and it won't let me. So Davi, so we've had a problem with this. You have to check your spam folder. So a lot of the times these emails will go to your spam. So please check your spam folder, and if that doesn't work, you could always just read the newsletters on the website. They are all archived, all 22 of them. But it's strange because the newsletter tends to have like a 65 to a 70% open rate. And I have a feeling we would almost have 100% open rate if these emails didn't go to people's spam folders. But so I signed myself up for the newsletter to my work email, and it always goes to my junk folder all the time. I'm not sure how to fix that. I was going to probably try to migrate to Substack, but after doing a lot of research on it, people that are using Substack are having the same problem. So I'm really not sure how I could figure that one out. But yeah, if you're not getting it and you signed up for it, check your spam folder. Kerry Henry says, love your cloud/building shots. Thank you so much. Thank you. Humane says, once you label it as not spam, it should show up as normal. I'm going to try that. Wendy England says, all the financial gurus say Canadian banks are very well capitalized. Ramos 13 says, super happy to see you. Miami is amazing. Well, I'm super happy to see you as well. And I hopefully you're having a good Friday. So this is the building I work out of right here, the 200 Southeast Financial Center here in downtown Miami. Beautiful building, one of my favorites. It has a fantastic view of the Miami Bay. Eyeglass Lady says, hey Tom, the newsletter used to go to my spam folder, but it doesn't do that anymore. Love that. Eyeglass Lady, hopefully you had a good week. Hopefully you'll get some time to take off and relax this Saturday and Sunday. Hey, Ruben is here. Says, hey there, good to see you, Ruben. Dr. Longus says, Tom, the Fed has to put us in a recession to deal with inflation. Is that correct? Well, yeah, so the Fed will use a term called soft landing. I'm sure a lot of people have probably heard that term, soft landing. But I think it's going to be very difficult for the Fed to achieve that goal of a quote-unquote soft landing, which essentially means that they get inflation under control while not falling into a recession. What I think is probably going to happen is the Fed is going to be forced to get more aggressive on raising interest rates, probably in increments of 75 basis points as opposed to 50 basis points, which is even out of character in itself, because usually it's a 25 basis point rate hike. I think if the Fed really cares about taming inflation, we will have a recession. But recessions are not bad. Recessions are normal. I think we've been so brainwashed to think that recessions are extremely bad. And I think one of the reasons for that is because politicians, the only thing that they care about is like their scoreboard and getting reelected. But if you let the free markets do their thing, recessions are very necessary to flush out inefficiencies in the marketplace. Hey, Matthew's here. This is quantitative tightening. Yes, that started on June 1st. Matthew, good to see you, my friend. Hey, Psychic Cosmonaut says i8 is my dream car. I think BMW makes them, don't they? Don Smith has been seeing massive blocks of crypto trading, not crypto traders. says Don Smith. Hey, Out and About is here, says give a thumbs up. Happy Friday, cheers. It's been a while. Work has been really busy for me. Out and About. Hopefully you're well. Out and About is our good moderator from Canada, from Toronto. What's up? T. Campbell says Bank of America has S&P going to 3,400. JP Morgan has a floor at 3,600. What are your thoughts? So my thoughts is that if you pull up a weekly chart on the S&P, and I think I shared this on my Twitter, if you want to follow @WalksWallStreet, I think the S&P 500 is going to have a third leg down and find support on its 200-week moving average. So if you guys have TradingView or any sort of free charting software, if you just put a 200-week moving average on the weekly chart, that's where I think we'll potentially find a bottom here. And the reason why I say that is because that is where we bottomed during the 2020 COVID crisis. But I'll take it a step further. So that's the technical level. Let's talk about fundamentals for a second. I think that's the most important thing. You guys know me, I mainly focus on fundamentals, but technicals do corroborate with the fundamentals. So here's what I mean by that. As you know, on the streams, we've been doing deep dives into all these major companies' earnings, right? We almost covered, literally, I would say probably about 25% of the companies in the S&P 500 that reported earnings. We did a deep dive into all of them. What was the number one common trend, or the commonality between all of those companies that posted earnings? Does anybody remember? Well, the biggest commonality, or the common theme, was every single chief financial officer came on the conference call warning about margin compression. So why is that negative? Well, a lot of the times people will say, oh, the S&P 500 is getting cheap because now it's trading at 17 times projected forward earnings, right? Or 16 times projected forward earnings, right? And that's all well and good, but that can be a little bit misleading because as companies report earnings, and we've seen earnings come in okay, but the forward guidance has not been okay. The guidance from every single chief financial officer essentially at these major S&P 500 companies have said we are predicting or projecting declining or decelerating earnings, and therefore they have adjusted or revised down their forward guidance. So a lot of the times when we trade off of those valuation metrics, even if we say, oh, the S&P 500 is super cheap right now, it's trading at 17 times forward earnings, well, that doesn't guarantee that next earnings season these companies don't take an absolute bath. So that's sort of the way I look at it. But historically, you were right. Should the S&P 500 get down to those levels, it'll probably be trading in the mid-teens projected times forward earnings, which is a very, very good place to add to your new positions or to existing positions in a retirement account. But that's not a guarantee of earnings, right? There could be companies, just like we saw with DocuSign yesterday, even though they beat on the top line, which is their revenue, they missed on earnings, and then they took it a step further to say we are actually going to guide lower. So we are going to take our profit projections and guide lower. So that is really the only thing that concerns me right now. Out and About says, did you hear about Justin Bieber's health? No, I did not. He has been diagnosed with Ramsay-Hunt syndrome. I have no idea what that is, but that's horrible. I never want to hear about anybody being sick. That's terrible. I did not hear about that, but I wish him the best. That's really not good news at all. Wow. I mean, is he going to be all right? Lena Sandoval is here. Says, hey, Tom, good to see you. Welcome, Lena Sandoval. James says, if they tell you ahead that earnings are going to be down, quit acting shocked when they really are. Pay attention. Yeah, James, that's a good point. It's actually a really good point. Mario, good to see you. Hey, the Mighty Bull is here. Welcome. Good to see you, Mighty Bull. So they just redid this entire street, but one of the things I really like about the new sidewalks here is they are completely level with the street view here. So every single thing in downtown Miami now, every single sidewalk and street is going to be redone like this. It's going to look really, really nice. Holy crap, Humane says his face is partly paralyzed. Oh my God. Ramsey-Hunt syndrome, RHS, is a rare neurological disorder characterized by paralysis of a facial nerve. Man, that's too bad, man. Well, I know that he had Lyme's disease, and Lyme's disease is no joke. And you know, I'm a Long Islander, being from Long Island. My family is from there. Not a lot of people know about Lyme's disease because there's a big problem out on Long Island of the ticks. So the deer, since Long Island is so, there's literally nowhere to go, right? It's not like the deer can escape somewhere. We literally live on an island. So the deer tend to get really, really sick. And when those deer get sick, the ticks will bite the deer, jump off the sick deer. And this mainly happens out in the Hamptons, in Watermill, New York. And the reason why I know this is because my cousins were from Watermill, New York, out in Southampton. And every summer when we used to go to visit them, I remember my parents would be so paranoid, and every time we would go outside, we would have to totally strip down and get checked for ticks. Because if you get bit by a tick and that tick is positive for Lyme's disease, that could be a really, really big problem. And you can develop all types of neurological disorders, like Bell's palsy is one of them, where your face gets all paralyzed and distorted. So it's very possible that that could be a byproduct of the Lyme's disease that he had. I mean, Lyme's disease is no joke, and really only Long Islanders are keen and aware of the fact that you know, people can get Lyme's disease. So hopefully it's not a byproduct of that, but it's maybe very possible. James says Lyme disease is terrible, hard to diagnose, and takes over your life slowly but surely. Yep, you're 100% right. Yeah, I mean, that sucks. I didn't want to hear that news. That sucks. Wow, Humane says, I cared for a dog for 7 months that was absolutely crippled from Lyme disease. Wow, northern Minnesota back in 2001. Man. You know what? We'll probably take a walk to the Mighty Bull, or the Miami Bull, as they call it. So we'll walk down here and then make a left. Hey, NMB045, what's up? Says, what's up, Tom? Happy Friday night. Good to see you, NMB045. So we just did a deep dive on the CPI numbers that came out today. Inflation is ramping in the United States. We did a deep dive into that. Also, you know, I did want to check out this restaurant. Every time I walk past this restaurant, everybody, it is always absolutely slam packed. So I'm not sure if anybody in the chat has ever been here. Hey, David Randall says, hey, Tom, are you still doing New York and Miami? Yes. So I'm splitting my time 50-50 between the wonderful city of New York and the beautiful city of Miami. Good to see you, my friend. Wendy England says, hey, Tom, it is monsooning out. Well, it was monsooning out here, too. I got caught in a crazy sort of mini hurricane when I went to get some lunch today. But yeah, due to today's CPI report coming in at about 8.6%, many economists were projecting readings of 8.6%. Many economists were projecting readings of about 8.2%. So coming in extremely, extremely hot. And the interesting thing now is the futures market is actually projecting or predicting 75 basis point rate hike as opposed to the 50 basis point rate hike because that's how serious the inflation is getting. So we'll quickly run through that report again. So if you guys go on my Twitter, there was an economist, I think, from the Washington Post. I forget what her name was, but
She was from the Washington Post, really did a fantastic job with breaking down line by line some of the products and services in the US economy that have suffered the most from inflation. So I guess we'll go over those again for the people who missed it. I think the biggest one, which affects the most people, is groceries. So for groceries, a year-over-year increase, 11.9%, and that is the biggest increase since 1979. Chicken, if you want to talk about chicken, the price of chicken has gone through the roof, a year-over-year increase of 17.4%. That is the largest single year-over-year increase ever on record. Restaurants, so if you were to eat out at a restaurant, that's up 9% year over year. That is the single highest increase ever. Fuel oil, 10.7%. That is the, 107%. So fuel oil year over year increase is up 107%. That is the largest single increase ever. Electricity, up 12% year over year, the largest since 2006. Just before the mega financial crisis of 2007, 2008. Rent, we talked about rent previous two streams, getting out of control, up 5.2%.